The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. My name is Jason Collins, and I'm here with URL Insurance Group. I'm an agent support specialist at URL, specializing in single premium life products. First off, I'd like to thank everyone for taking the time out of your busy schedule to be with us today. Those of you that are currently doing business with URL, I'd like to personally thank you. We understand that you have many options as to where to place your business. That's why we appreciate you working with URL, and we'll promise to continue our dedication to your success. Some of you are new to the URL family. Welcome. URL is a full-service national broker. We provide agents complete support in all of our lines. URL provides single premium life, fixed and indexed annuities, traditional life products, as well as individual and group health products. We also have a senior division that offers MedSup and MedAdvantage products. Please take a moment after the webinar to tour our website at www.urlinsgroup.com and discover if there are any additional avenues for URL to assist with your success. Again, that website is www.urlinsgroup.com. Now, I'm extremely excited to be part of presenting this great program for you today. Single premium life has been growing in popularity over the past few years. People, and more specifically baby boomers, are realizing that they have cash value in old whole life policies that they don't want to continue to pay into. They have money that is set aside and earmarked for the next generation, making little or no interest in CDs or savings accounts, and have real concerns about their future with regards to long-term care should they need it. Today we're going to discuss a product that will help your clients with these concerns. I'm proud to introduce Jon Thomas with Nationwide Insurance. Jon is Nationwide's virtual wholesaler for long-term care sales. He's here to review Nationwide's CareMatters single premium life product and to discuss how it will benefit your clients. Now, before I turn it over to Jon, I'd like to mention, should you have any questions during the broadcast, there is a question box on the right side of your screen that you can type the questions in, and we will answer them at the end of the program. So without further ado, I'd like to turn the program over to Jon.
Thank you, Jason. Really appreciate that introduction. And really thrilled to be able to share with you all this morning. Thanks for joining the call. As I get my screen up here shortly, we'll get started. I do want to take 30 minutes of your time. We'll say 30 to 40 minutes to go over our nationwide long-term care solution and then address any questions you may have at the end. And feel free to go ahead and type questions into the chat box as we go. Or you can save questions towards the end, and we can address those questions then. Again, thrilled to be able to share with you. I've shared a few times with webinars for URL, and always happy to share more. And I'm really excited and thrilled to share about our New York product. For those of you that are familiar with long-term care and maybe have business in the state of New York, you know some of the challenges of regulation in New York, the challenges of getting product approved, or the limitations in long-term care solutions there are in the state of New York. So that's something we're thrilled about. And I'm going to talk about the solution and then about the opportunity there is in the state of New York with this recent approval. The product was approved a few months ago in the state of New York, and we're rolling it out and actually launching it officially as of July 17th. For those of you that are not familiar with Nationwide, I do want to give just a little bit of a background on Nationwide and maybe give you a framework of who we are and why you might do business with Nationwide. You know that we are a mutual company. You may know that we're a property and casualty company, right, that we sell auto and homeowners insurance. You've probably seen a commercial or two of Nationwide. Maybe you've heard the jingle, Nationwide is on your side, right? You know, we are a mutual company, and that motto, Nationwide is on your side, really is more than just a slogan for us. It is something that we've earned due to our claims experience. We've won countless awards in our claims experience, whether it comes to an auto claim or a homeowner's insurance claim, but we live to excel and deliver for our customers, really our members, when it comes time to deliver for a claim or on a claim. And in the long-term care world, as we're developing and engaging in long-term care solutions more as a brand and as a company, we want to take that claims experience from homeowners and auto insurance to long-term care insurance. This is a critically important solution, right, as we talk about retirement planning and success in retirement planning. We know that the two major concerns of consumers are running out of retirement income, and then second, healthcare costs and long-term care costs in retirement. Those are the two biggest concerns of consumers, and long-term care costs is the thing that is more likely or most likely to deplete someone's retirement income and disrupt their retirement plan, right? And so it needs to be a critical part of our conversation. And so Nationwide wants to engage in the space as we are a financial company as well, and we offer mutual funds, retirement plans, life insurance, annuities, you name it. Long-term care is part and parcel of a broader financial plan and making sure our consumers are successful in living out their retirement, right? We've been in the business for 90 years, $26 billion in operating revenue as of 2015, and you see our financial ratings here. A+ with AM Best, A1 with Moody's, A+ Standard & Poor. And so we are a strong and stable company. We've got a diversified corporate portfolio. To share a quick story, if you think back to 2008 when we had the market crash due to the housing market crumble, right? And companies, especially financial companies, were taking bailouts from the federal government. A lot of companies went under. Right? It was a tough year for Nationwide as our financial company itself is on the Fortune 500 list. We have a sizable financial brand. So we had significant loss in our financial company. But believe it or not, as a company, as a total company, we had a surplus year because we had such a strong year with our commercial property and casualty and our personal property and casualty companies that we were able to sustain the losses we took on the financial side. And so we believe as a brand, because we've got this diversified group of companies, that we can sustain and ride any financial wave that comes our way. And when you're talking about long-term care solutions and long-term care companies that you do business with, that is critically important, right? Because we're delivering a solution that the client may not need for 30, 40 years down the road. But you want to know that the policy that you sell them is going to be delivered by the company that's on that paper, right? That 30 years down the road, Nationwide is the one to pay out those claims. And so Nationwide is well-positioned, as well-positioned as any company in the industry to deliver on these promises. So as we're having this conversation, I'd love for you to think of Nationwide as that dependable, stable mutual company that you choose to do business with because you know they will deliver for consumers down the road. Before we really jump into the product conversation, I do want to maybe shift your perspective a little bit. I know as a long-term care industry, we have focused quite a bit on qualified long-term care costs, right? As we have that conversation about planning for long-term care, the conversation normally starts with you have this specific retirement plan, right? You have income and you have these qualified assets set aside to create income, and then you also have savings. Now, if you have to pay for long-term care and qualified long-term care costs X amount, right, this huge number that we typically get a projection for, and if you have to pay for this care, it's going to demolish your retirement plan. So there's significant financial risk if we don't plan for these qualified long-term care costs. And that's generally the conversation. But that perspective somewhat is a myth, and I think people recognize that, and they recognize that it's not always the case that qualified long-term care expenses are something that they're going to incur. If we look at the data going back to 2015, there was a total of $242 billion spent on qualified long-term care. Now, I'll define qualified long-term care as nursing home, assisted living, other qualified long-term care living type of places, whether it's assisted living or some other dormitory type arrangement, right? And also qualified in-home care. That's where a qualified nurse or medical person comes into the house to provide care. What is not included is informal caregiving. Informal caregiving is care by family members, maybe a spouse, maybe children, maybe a niece or nephew or other extended family, or loved ones in the community, right? Friends, maybe folks from the local church or local community or associations where they provide care for one another, right? Informal care is not included in that $242 billion. So if we look at how care is being administered in the United States, in that same year, 2015, as a matter of fact, $522 billion was spent on informal caregiving. So that is significant. It's something we need to recognize that as we look at the elder care scenario, right, that care starts at home. That generally speaking, it's actually more rare that someone has a stroke or some other significant event that puts them into an immediate facility. More often than not, as we age, we become more frail, and care starts at home, and it starts with our loved ones. As a matter of fact, loved ones generally provide care for as long as they can until that person's frailty or their medical condition increases to the point where they need some sort of qualified assistance. But generally, care starts at home, and a large part of that care is administered by family and other informal caregiver sources. So it's a significant part of the conversation, and Nationwide wants to address that part of the conversation with our solution. If we take that down to an individual level, a family level, and we look at what families lose providing care for one another, it's estimated that over a lifetime, on average, a family loses about $300,000 providing care for one another. And what this generally looks like is a family where the eldest daughter, in most cases, will move back home. She lives out of state. She'll quit a job, maybe reduce hours on a job if she lives locally, and use that time to provide care for her mother or her father or her parents. And so she loses significant income. In some cases, it's the son, but in many cases, it's the daughter, and loses significant income and benefits because she's reducing her career or stepping aside from her career for a period of time to provide care for loved ones. So there is significant personal loss as well. And so as we're having this long-term care conversation with Nationwide, we'd like to expand that conversation, that financial planning conversation, and say, it's not just qualified long-term care that we need to plan for. It is all of the costs associated with aging and needing some sort of help with frailty, right? Whether it's some sort of qualified long-term care, whether it's family that comes alongside and provides the care, we have a solution to address all of these needs. Right, and as a matter of fact, if family provides the care, we can replace any lost income that they might have providing this assistance, knowing that this happens a significant amount of the time. One of the ways that Nationwide addresses this issue is that we are a believer in a cash indemnity long-term care solution. This is huge for us. As a matter of fact, we're one of the first insurance carriers in 1998 to introduce a hybrid long-term care solution, or a long-term care rider on life insurance that basically said you can use your life insurance death benefit early and use it for long-term care, and we developed a qualified long-term care rider to do so. So that was introduced in 98. It was an indemnity benefit at that time. We've remained an indemnity benefit carrier, and then introduced this solution about 3.5 years ago, which we'll call the asset-based long-term care solution, or alternative investment long-term care solution. And I'll get into a little bit of the details as we go, but we are a cash indemnity benefit, which basically says that when you need long-term care, you file a claim against your insurance policy, Nationwide is going to pay you income on a monthly basis for you to use however you like, whether it is qualified long-term care, whether it is informal care, whether it's a spouse providing care, or you're saving that money, you're using it to modify your home so you can stay in your home longer, or you're applying that money towards other medical costs that may arise. That income you can use for whatever you please. That is different from the standard in the industry. The standard in the industry is a reimbursement type solution, which offers you a stated benefit and says if you have qualified long-term care costs, which doesn't address this informal need that we're talking about, but if you have qualified long-term care costs, you can submit bills and receipts of those qualified costs and get reimbursed from your policy. Now, there's a couple of risks with that type of solution that we'll talk about as we go along in the call here. And I mentioned informal caregivers are covered under Nationwide's policy, and then a 10% guaranteed minimum residual death benefit. This is specific to the state of New York. And so a couple of the comments I'll make here are specific to the state of New York, and I'll talk about both. Our national product has a 20% residual death benefit, which essentially is an attached final expense policy that once we use our policy for long-term care, we have some benefit left. There's an extra or an attached final expense policy that pays out on death so that the family still gets a benefit even if we use the entire policy for long-term care. So it is 20% in our national product and 10% in the New York version of our product. That second bullet point, you see there, optional benefit banking available. That is a critical part of our solution, and it is different from what you might recognize with other sort of long-term care solutions. When other long-term care solutions talk about benefit banking, what they mean is that if you have excess benefit that you're not able to claim in a reimbursement type of policy because you don't have the qualified expenses to get all of your benefit on a monthly basis. Maybe your benefit is $10,000 a month, but you only have qualified expenses to show for $6,000. Well, then $4,000, that excess that you're not able to claim, it stays inside the policy, and it builds up inside the policy. And if you're able to, or once you get through your base benefit period, maybe it's a 6-year long-term care benefit, maybe it's an 8-year, but once you get through that initial benefit, on the back end of the policy, you can start to claim some of those built-up benefits. But the risk there is that if you pass away at any point during the claim, any money that's built up inside the policy stays with the insurance company. You don't get any benefit of having it. And so you're leaving a lot of benefit on the table because it's building up inside the policy. With Nationwide's benefit, we guarantee maximum benefit payout as income on a monthly basis. And if you're getting more benefit than you have cost for, that's perfectly fine. And you can bank that benefit, or you can save that benefit in your personal bank account, whether it's your savings account, checking account, money market. You pocket that away in your personal account so that if you pass away as the insured, that money belongs to you and it passes down to your kids or your heirs or your grandkids. And so it's a significant difference from a reimbursement policy. And then that money that you get on a monthly basis is guaranteed to come to you as income. And so you have the benefit of using it even if you don't have expenses to show for it. Some of the other opportunities that exist with a cash indemnity policy are planning for wealthy individuals. This is something, an opportunity that really doesn't exist with a reimbursement or a traditional type of long-term care policy, is using it inside of an irrevocable life insurance trust. The way that Nationwide's policy is structured, that indemnity or that cash benefit pays the owner of the contract. And so we can name an owner that is different from the insured. And because when Nationwide pays a claim, a long-term care claim, we pay the owner of the contract, we're not reimbursing the insured for their qualified long-term care expense. We're paying the owner in income. And because we're paying that owner the income, if the owner is a trust, we can pay the trust without violating the terms of the grant or invalidating the trust. So there's a significant opportunity to use this sort of solution to provide some extra tax advantage or tax arbitrage for wealthy individuals that might want to take advantage of a long-term care plan inside of their irrevocable life insurance trust. So there's a good or a great opportunity there for those wealthy individuals trying to avoid maybe some extra estate taxes. Again, we won't collect bills or receipts. Nationwide pays that claim on a monthly basis as income, and we'll pay above the HIPAA cap on the extension of benefit. And I'm going to get into an infographic here shortly that'll kind of explain the details of how it works. But that cash benefit, it really is flexible. I want to reiterate there are no restrictions on how that benefit's used. Excess benefits can be used for anything, whether it's transportation costs, some of the ancillary costs that occur. You're hiring, kids down the street to mow the lawn and someone to come in and do some housework. Those ancillary costs, you can use this benefit to cover those, whereas a traditional or reimbursement type contract that only covers qualified long-term care would not have benefit to cover those things. So it really does open this policy up to be used and utilized however that insured needs as they're in that state of needing care. Now, a couple of dates to be aware of, and I did mention this, that the New York product that's just been released, we can issue a contract as of July 17th. And so if you have clients you're thinking about, if you're interested in taking a look at it, just be aware that July 17th we can officially write a premium and issue a policy. So that's just an important date to be aware of. Now, getting into how the policy works, I want to walk through a scenario with you that maybe explains this asset-based type of care and gives you an example of a good situation and where it fits. But before I do, to give you an overview, and I know many of you are very familiar with long-term care policies and their origin, but just briefly, this is really a combination of traditional long-term care and long-term care on life insurance. So you have traditional long-term care that was a stated premium, maybe a monthly premium that gives you a stated benefit, and when you file a claim, you get that benefit. But that's really all there was to it. It's very much like auto insurance where you pay this monthly premium and you have this benefit when you need to file a claim. The risks there is that if you never end up using it, if you're one of those folks that maybe you have a full life, you pass away and you never need to file a claim, then you get nothing for it, right? So that was one of the obstacles in selling traditional long-term care. One of the second obstacles was that the premium was not guaranteed, right? That over time, and we've seen this in the market, that over time premiums have increased, in some cases significantly, which to some degree has soured consumers against traditional long-term care because they've seen a lot of those premium increases over the years, right? And then you have the hybrid solution, which is a life insurance policy. It's sold as a life insurance policy for someone that needs death benefit protection. But you can add this rider that says, well, you know what, down the road, if you never end up utilizing the death benefit, if you don't pass away when your kids are living at home and you no longer need it for death benefit, you can add this long-term care rider that allows you to use the death benefit late in life for long-term care. And so those are really the two solutions. This linked benefit came about because we wanted to bridge the gap of those two solutions, right? And so we took a life insurance policy, which offered a few of the things that traditional long-term care didn't offer. It offered guaranteed premium. It also offered a death benefit. Now, the death benefit in this case is really meant to be a return on investment. It's not designed to be a death benefit solution like life insurance, but really a return on investment that says you're going to invest a significant amount of money into this contract. And so if you pass away, you're going to get a return on that investment. And so it's not a use it or lose it type of scenario like the traditional long-term care was, right? And then on top of that, we do want more long-term care than just life insurance can offer. And so we're going to attach a long-term care contract that pays extra long-term care benefit than a hybrid or long-term care rider on life insurance would pay. And so it really is a combination of both. And Nationwide, as you see on the page here, is a combination of the two. We have a base universal life contract that offers life insurance and or death benefit and long-term care, and then an attached long-term care policy that is purely long-term care benefit. And it is an alternative investment. So we're looking at someone that is willing to reallocate or reposition some of their assets to get leverage for long-term care and to cover their long-term care risk. And so generally, or with Nationwide's product specifically, we'll allow a single pay, 5-year pay, or 10-year pay. The 5 or 10-year pay can be annual payments or monthly installments. But in this example, we have a 55-year-old female. And this 55-year-old female purchased a 6-year benefit, long-term care benefit with no inflation. And I'll explain the inflation options here shortly. But this 6-year benefit on a 55-year-old female, we'll say she worked for state government her whole life. She's got a significant pension. She's able to retire at 55, and she's got savings in the bank. Along with those savings, maybe she got a lump sum payout at retirement, and so she's accumulated about $500,000 in savings that she has sitting in CDs at the bank. Right? So her income is taken care of by this pension. But her significant risk, should she have to pay for long-term care, is that money she set aside in the bank. Right? Her income is covering her lifestyle, and it's really just enough to cover her lifestyle. That lifestyle isn't necessarily going to change just because she needs some care. Right? She's still living at home. She still has expenses. She still wants to travel a little bit. She has a fixed lifestyle. That's really not going to change. So that her income covers that. But if she needs long-term care, that $500,000 she's worked hard for, right? She wants to pass it down to her kids or her grandkids, and so she has it sitting in the bank. But if she needs to pay for care, we don't want to allocate that $500,000 in savings to pay for care, right? Why not take a portion of it as part of her overall portfolio and reposition it into a solution like this. And so that's what we do. We take $100,000, reposition it into this CareMatters product, and it gives us $515,000 of total long-term care coverage. So we've in a sense doubled her overall portfolio, and half of that is utilized, or we can use as income to cover her long-term care risk. Right? The $100,000, it gives her initially a death benefit of $171,827 in this example. So that's available as death benefit should she pass away and never need long-term care. And so her portfolio or her estate recovers her $100,000 investment plus an extra $72,000. If she does need long-term care, she's going to file a claim with Nationwide and begin receiving $7,160 in monthly benefits. That income is payable, and it will reduce this death benefit dollar for dollar until this is exhausted. Once this is exhausted, we're going to continue to pay this 4-year benefit or the attached long-term care contract for a total of 6 years in this example. Now, we have benefits available anywhere from 2 to 7 years. 6-year happens to be one of the more common options. What you find is that the average claim generally in the market has been about 4 years. And so people look somewhat from a 4 to a 6-year benefit. The 6-year price is quite well, and it's enough to cover more than the average 4-year claim. So you find that people generally purchase about a 6-year benefit. Now, this is a infographic that shows you how our product works on our national product as well as our New York product. One important differentiation I want to make is that our national product, if you add inflation, and we have an inflation rider of that you can add that's 3% simple or 5% compound, the inflation in our national product applies to the total benefit. So this total benefit would inflate on our national product. With our New York product specifically, the inflation actually only applies to the attached long-term care contract. And so in New York, when we file a claim, our insured would get $7,160 in this example for 2 years. Once that's exhausted and we get to this attached long-term care contract, we're going to have the advantage of getting our inflation. So that $7,160, if it we added a 5% compound inflation, let's say, and that jumps to $18,000 a month because it's been 20 years before we file a claim. Then once we're through this 2-year benefit, we're going to jump to the higher amount of $18,000. Now, in the national product, when we file a claim, we'd get that higher inflated amount from day one. So that is one of the differences between the national and the New York product. The residual death benefit you see here in this example, it's payable even if we use the total $515.41 in long-term care. We'll pay an additional $17,183, that attached final expense policy. Again, in the national product, that would be 20% of this $171,827. Whereas in New York, we're at 10%. I want to talk through some of the other differences in our national and New York product. We did address that inflation of 3% simple and 5% compound. It's available on all of our benefit periods in our national product. With the New York product specifically, it is only available on the 4 through 7 year benefit. Because the base policy is comprised of either that first 2 years or 3 years, and in New York we can't have inflation on the base period, it's only available on the longer benefit duration, the 4 through 7 years. So that's specific to New York only. The national product, you can add inflation even if it's a 2 or a 3 year benefit. So that's something to be aware of. The return of premium, the product does have full return of premium. Our national product has a 100% return of premium after 5 years. It's on a vested schedule. Year 1, a person files a claim, year 1, someone decides to cancel the contract, they would get 85% of the premium back. And that increases each year. And after 5 years, they cancel the contract, they get 100% of premium back. The New York product specifically has a different ROP. It's 80% in the first 10 years and 95% after 10 years. There are a couple of reasons for the difference in return of premium But one of the reasons, and this is actually an advantage to the consumer, it's a consumer protection that exists in New York that says that even if someone lapses their policy, that Nationwide is on the hook to still pay a minimal long-term care benefit. Now, this is a fully guaranteed product. Once we pay premium, it's fully guaranteed. That premium can increase. But a way that the policy would lapse is if that insured withdraws all their cash value. So they could choose to withdraw the cash value, and that, in a sense, would lapse the policy. Well, if they chose to do that, they withdrew all the cash value, the policy would otherwise lapse. It actually, in New York, is going to turn into a reduced paid-up benefit. And that benefit is equivalent of $1,500 a month for 12 months. And so someone could essentially withdraw all their cash value and still have $1,500 a month for a year in long-term care benefit if they have to file a claim down the road. And so having that reduced return of premium was really used as a hedge against the cost of having to pay a claim, even in cases where someone withdraws all their cash value. There is a 90-day elimination period on all of our products. It is calendar day. Another consumer protection that exists in New York is this retroactive benefit. That is not available in our national product, but specifically in New York, that says once we get through our 90 calendar day elimination after filing a claim and before those benefits begin, Nationwide is going to pay a retroactive benefit. So on the 91st day, we're going to pay a lump sum payment that represents the 3 months that we've had to wait, plus the 4th month that's coming up. So we'll get a lump sum for 4 months of benefit when we file a claim after 91 days in New York. So that is a fantastic consumer protection that exists for New Yorkers. The residual death benefit is 10%. It's capped at $25,000. So that's something to be aware of as well. 10% up to $25,000. And our level and single pays offer the same leverage inside of New York. If you've looked at our product and you understand life insurance, you recognize that generally if you pay something up in a one-time single pay, it's going to provide generally more benefit or more leverage than maybe a 5-pay or a 10-pay. And that is the case with our national product. With the New York product specifically, we're going to offer the same leverage, whether it's a single pay or a 5-pay or a 10-pay. So in that example where we looked at $100,000 that bought us $515,000 of long-term care, on the same token, a 10-pay, $10,000 over 10 years, will still get us $515,000. So we get the same benefit regardless of a single pay or a 5 or a 10-pay in the state of New York. So that is unique with this New York version of the product as well. So fantastic opportunity, especially for folks that may not have those assets sitting in the bank, but would like this sort of solution, right? They could fund it maybe at $200 or $300 a month over 10 years. So it makes it affordable for those folks. The minimum and maximum issue age, it is 40 nationally, and it is 75 nationally, up to 75, from 40 to 75 nationally. Now, when we look at the New York product specifically, I'm going to break it down for you because it does vary from the national product. The New York product, we can do our 4 through 7 year benefit up to age 67 on a single pay. 5 and 10 pay, we can issue up to 70. When we look at the shorter benefit period, a 2 or 3 year benefit, the single pay we can issue up to 69. In the 5 and 10 pay, it varies a little bit. You see in the chart here, whether it's a 2 or 3 year benefit, it might be 75, it might be 73, 72, 71. It depends on whether it's a 5-year, 10-year pay or a 2 or 3 year benefit. And what I would say is, this isn't something that you really can remember. But if you look at an illustration or you call URL and get an illustration run, the software will advise you on what benefit design might work for someone that is between 70 and 75. For one of those older folks that is interested in this type of solution, the software will help guide you into a solution that might work. And so if you run the software, it's not going to give you a proposal or an illustration that you can't sell. So just want to reiterate that, that it will guide you as you have an older client that you're looking for a solution for. underwriting and new business. Now, this is a simplified underwritten product. This is fantastic because some of those hang-ups we have with underwriting on life insurance don't exist with this product. There's no medical record requirement. There's no paramed requirement where we have to go and collect fluids, blood and urine. And so a lot of those things that take underwriting make it lengthy, that we're waiting around for records or for the client to get their paramed completed. Those things don't exist. It is a simplified product which allows for just a quick interview and then a follow-up telephone interview with the client. So quick application and telephone interview. So when we receive the application, Nationwide is going to call out to the client. We'll schedule an interview, and the interview generally takes about an hour. If someone doesn't have significant medical history, it may be as short as 20 minutes, but we generally try to advise for clients to prepare for a full hour for this interview. The interview is somewhat extensive. It asks them all about their medical history, previous conditions, previous diagnoses, medications, prescriptions they're taking, and we really try to get an overall picture of their health, not just in the current state, but their historical health. And so they do need to have some information at their fingertips about previous diagnosis, especially if they've had significant conditions in the past, like cancer, where it's been treated and what that history has looked like. But we really try to get a sense over that hour, and after that hour, we make a decision whether it's either approved or declined. There's not multiple underwriting ratings. It is either approval or decline. And I'll tell you, through that simplified process, we do approve about 80% of all applications. And so we do have significant success avoiding, medical records and paramed, and just having this interview with the client and have success getting them underwritten. So it does cut that underwriting process down to, I see these get approved in as little as 3 or 4 days, but generally it does take about 2 weeks. And a majority of that time is scheduling the interview for the client to have, find time in their calendar to free up an hour to sit down on the phone and complete the interview. One of the pieces of that interview that exists on our national product is a cognitive screen. The cognitive screen is really a memory test that's looking for signs of early Alzheimer's and dementia. That is something that exists nationally. It tries to screen out folks that might have early onset Alzheimer's that hasn't been detected otherwise. That portion of the exam does not exist in New York. So there's no cognitive screen in New York. And so that's something I want you to be aware of as well. It makes the interview a little bit easier for New Yorkers, and it makes the interview shorter. Whereas it might take an hour outside of New York, it may take 45 minutes inside New York because we don't have that cognitive screen portion. Now I want to highlight from a pricing standpoint some of the opportunity here and give you a quick snapshot of what the pricing might look like and where the opportunity is. This screen here, if you can see, I know the numbers are crunched up a little bit, but you can kind of see what these proposals look like. We're going to compare our national and New York version of the product. And this is a female, age 60, no inflation, a 6-year benefit, $100,000 investment. It is a couple rate. I didn't mention previously that there is a couples discount that is applied to premium, that anyone that is married or in a domestic partnership automatically gets a discount. And they both of the married couple don't have to apply to get the discount. Just simply being married gives you the discount. Now you'll see here the national product, the $100,000 investment on this 60-year-old would equate to about $473,000 in total long-term care benefit, or $65.69 a month for 6 years, with a residual death benefit or that attached final expense policy I mentioned of $31,532. That is 20% of the original specified amount. In New York, that equates to about $445,000 or $61.84 in monthly benefit for that same $100,000 investment. The residual death benefit's less at 10%, so that's $14,841. Now, if we take that $100,000 investment and look at the same person, the 60-year-old female, with $10,000 over 10 years, our national product, that reduces because of the difference in leverage to $379 total long-term care benefit or $52.69 a month. The New York product, as I mentioned, it has the same leverage, even though we're paying it over 10 years. And so it's still $445,000 or $61.84 a month. And so you can see here the pricing advantage in New York, especially if we're looking at someone that's willing to do a 10-pay or can afford a 10-pay. Here is an example with 3% inflation added, a 6-year-old 3% inflation, 6-year benefit, 10,000 10-pay. And you can start to see the advantage the New York policy has over our national product. The initial benefit is $3,260. Over 10 years, it grows to about $4,238. The New York product starts at $5,266 and grows to about $6,846 a month. And so we're at about $2,500 more a month that the New York product has over the national product. So significant pricing opportunity here. I want to highlight some pricing differences with Lincoln MoneyGuard, and really what I want to highlight, and really why we're excited about the launch of this New York product, is there's a limited long-term care solution available in the state of New York due to some of the regulation challenges, right? Whether it's traditional or hybrid products. Of this type of solution, this asset-based long-term care solution, there's only one product that's been there for some time. It's Lincoln MoneyGuard. You may be familiar with it. They've been the only product approved in the state of New York and the only opportunity folks have had to use this type of solution. Now that Nationwide's in the market, we've gotten our product approved, we're enhancing the opportunity to distribute product in New York. And so for you, that is additional opportunity for new clients, right? What you'll see is a pricing comparison on female and male from 40 to 70. This example is a $10,000 10-pay. And you'll see a difference in this orangish pinkish column of anywhere from 2 to 7%, or even 2 to about 10%, where Nationwide has more in benefit than the existing Lincoln MoneyGuard product. But what you also see is these columns of not applicable. And what that is that MoneyGuard is not currently offering products to clients at that age band. And so from 40 to 50, if someone's interested in this kind of solution, they don't have it available in the existing Lincoln product. And so that now that Nationwide has a solution, you have the opportunity to offer this solution to a broader range of clients. In this case, from 40 to 50 or over 65. If we look at 3% inflation, that's expanded even more. Once we add 3% inflation, Lincoln MoneyGuard has even more limited distribution. And so if you see here for a male, MoneyGuard's product stops around 55. Well, Nationwide now has a product that you can add 3% inflation and offer a solution all the way up to 70. So we're thrilled that not only are we introducing a new product to the market, but we're expanding the opportunity to offer this type of solution to a broader range of clients. And that's really where we think the opportunity is to continue to grow this long-term care story, in this case specifically in New York, with a broader range of clients. Now these were 10-pay examples. That is really where we're priced well in the state of New York. As a single pay, what you'll find is we have about a 10% premium difference than the existing MoneyGuard product. Now, Lincoln MoneyGuard is a reimbursement contract. Nationwide, again, is Indemnity. And we will leverage about 10% less on average in benefit than Lincoln's current product. So that's something to be aware of. And that has to do with a pricing on a single pay of a reimbursement type of solution versus a cash solution, which guarantees a full monthly benefit regardless of cost. And so when you sit down and you show a client two solutions, a reimbursement or a cash solution, the cash solution will have about 10% less in benefit overall, but it is guaranteed cash versus a reimbursement that might reimburse you for qualified costs should you have them. That being said, you still see those not applicable columns from 40 to about 50 and over 60, where there is opportunity to offer this solution where there's not currently a solution in New York. So I did talk a little bit about underwriting already. I do want to pause our presentation here and open it up for any questions that might have come up during the call. Jason, did you have any questions come up in our chat box?
There is nothing as of yet, John. So I think you can proceed as planned.
All right. Fantastic. Well, I'll close out the call walking through an example of really the opportunity when you're showing a client an indemnity solution versus the reimbursement type solutions that exist in the market today. And it really comes down to not just showing a proposal and saying this is the benefit that you might expect when you file a claim, but it's really talking through what a claim might look like. And this screen here shows a claim scenario, and we're going to assume a $3,000 monthly claim for 4 years. I mentioned earlier in the call that the average claim is about 4 years. As a matter of fact, for folks that go to a nursing home, the average nursing home stay is about 2.5 years. And so generally you see a combination of home health care and nursing home care for somewhere in the range of 4 years. And at $3,000 a month. Now, what I understand, and especially if we're talking about New York or the Northeast where cost of living is quite a bit higher, that might sound small. But the claim with long-term care and the need for care is progressive. And what that generally means is that the cost and the need for care increases over time. So where we initially file a claim and we might be at home receiving care from a loved one, right, and maybe a qualified nurse is coming to the house once a week for 30 minutes just to check on the insured, right, which is a fairly minimal cost. And then over time, as the need for care increases and our family can't continue to keep up the level of care that's necessary, we might bring a caretaker to the house 3 times a week or for a few hours every day, right? And that's where the cost starts to increase. And then maybe over the length of 4 years or 5 years, we end up in a nursing home for a few months to a year as we need round-the-clock custodial care. And that's generally the progression of a claim. So that claim might start out at a couple $100 a month, right? And then towards the end of the claim, when we end up in a nursing home, that's where we're at $10,000 a month. But over the life of that claim, with that progressive need for care, we'll say it averages over that period of time about $3,000. In some states where the cost of living is higher, we could assume probably a higher figure, but for this example, we'll say $3,000. And we're looking at 2 possible options, a reimbursement option or a cash option. And we'll say that the reimbursement option, on the face of it, offers $6,000 a month. You see that on the left-hand side. The cash solution offers $5,000 a month, which is common as you're comparing these products nationally, right? The cash solution leverages less, but is guaranteed to pay the full benefit regardless of cost. Now, in this claim, this 4-year claim that averages $3,000 a month over that period of time, the reimbursement solution is going to pay out, on average, $3,000 a month. It's going to pay out the cost of that claim. So over that 4-year period, you have $144,000 paid out or reimbursed. On the right-hand side, our cash benefit, it's going to pay the $5,000 regardless of cost. So that $5,000 pays out over 4 years for a total of $225,000 over that 4-year period. Now, our national product does have a 90-day elimination period. We did talk about that a little bit initially. And so you see there in parentheses 3 months 0, and then after that 90 days, our benefits begin. That's where we get the $225,000. It's important to note in New York, as I mentioned, there's a retroactive payment that you'll get a lump sum payment for the 3 months that you had to wait once you file a claim. But you see here that because we have a guaranteed income stream, a maximum benefit regardless of cost, we have an opportunity to get our full benefit regardless of what our cost is. And so there's an opportunity to guarantee or be assured of our benefit when we don't know what our cost in the claim might be. As a matter of fact, if we take that claim a little bit further and we say that, what if this person doesn't pass away after 4 years, but they had a 4-year claim at average $3,000 and then they go to a nursing home, and that nursing home might cost $8,000 a month. We'll use $8,000 as a national average. Well, on the left, our reimbursement solution, it pays us up to $6,000, right? And our nursing home costs $8,000. And so we have a shortfall of $2,000. Well, that's $24,000 over a year in the nursing home. That's out of pocket, right? We might have been able to bank money inside that policy, but it still caps us out on a monthly basis at that $6,000 maximum. And so we are paying money out of pocket. In fact, $24,000 in this example. The cash policy continues to pay us that $5,000 monthly income. Our nursing home costs $8,000. What you see here is that we were able to bank $81,000 in our personal bank account, not banked or built up inside the policy. And so that $81,000 we have in cash in our savings account or brokerage account or money market, and that $81,000 is more than enough to cover the $36,000 shortfall we'd have in our cash benefit, that monthly income we're receiving, for not just 1 year but 2 years, right? And then still have some left over. And so when you can get to your cash benefit early, because you can access it with Nationwide when you're receiving care from a spouse or a loved one, which means you can get to that benefit faster. You can save it in your personal account if you don't have expenses, and then you can access it down the road should you have qualified expenses that are higher than your monthly income. You really have the opportunity to maximize the benefit you get out of the policy versus a reimbursement solution that you can't claim when you have informal care. And then when you do have qualified care, if you don't have qualified care that meets or exceeds your monthly benefit, you're leaving money on the table. And so this solution really gives you an opportunity to maximize benefit and get the most out of a long-term care solution that you can. As we close here, there are a couple other solutions or just an overview of the Nationwide solutions. I talked a little bit about the long-term care rider that we have on life insurance. It's also Indemnity. We've had that for since late '98. We've had that solution, so about 18, 19 years. CareMatters, which is the solution we talked about today, we've had it for about 3.5 years. About 1.5 years ago, we introduced a long-term care rider on our survivorship SUL policy, which allows us to cover 2 lives in a survivorship universal life contract, and then add a long-term care rider, which has a pool of money for both parties in an SUL type of policy. And then we're actually introducing an enhanced long-term care rider on our life insurance policies. We're calling it the Long-Term Care Rider 2, which you'll hear more to come over the coming months, but it is something that we're introducing as we speak. And so that's something that will offer an enhanced benefit. Our current long-term care rider allows you to accelerate 2% of a life insurance death benefit. The second version will allow you to enhance 2%, 3%, or 4% of the benefit, so you can get more of it faster. And there will be some other differences to this second enhancement of the long-term care rider that is to come. So that's kind of a progression of where Nationwide is with our long-term care solutions, just to give you that broad overview. Well, that's what I have for you today. I hope that was helpful and informative and give you kind of a broad or introductory explanation of our CareMatters solution and where the opportunity is in our national product and New York. Jason, any other questions that have come through?
There are none, John. No questions. Sounds like you did a fantastic job explaining everything.
Well, I hope so. I'll take it to mean that.
Yeah.
Well, I really appreciate everybody's time. And Jason, again, thanks for hosting me on the call today.
Yeah, absolutely, John. I appreciate that was an awesome presentation. I'd like to remind everybody, what you had talked about earlier with the differences with these hybrid life insurance policies with long-term care assets to it. And these policies are truly provide your clients the availability to use it, give it, or get it back features. So I want you to remember that little phrase. They're able to use it with long-term care needs. They're able to give it as far as a death benefit, and able to get it back with the 100% return of premium after 5 years in this particular product nationally. So I want to thank everyone for joining our presentation today. Please feel free to give us a call at URL for all your single premium life and annuity needs. Should it be brochures, illustrations, or simple answers to your questions. Our toll-free number here is 1-800-926-8875. Again, my name is Jason Collins. I'm at extension 156. You can always ask for Joe Corio. He's at extension 111, or Maria Adams at extension 102. Thanks, everybody, and have a wonderful day.